Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. Our guest today is Pramod Gubbi of Marcellus. Pramod, great having you. Thanks for joining in. Hope all is well.
Thanks for having me. It's a pleasure to be here.
Yep, the pleasure is indeed ours. Pramod, two or three key points instead of making it a very broad conversation. In light of the fact that global inflationary pressures don't seem to be receding, if the Fed's commentary is anything to go by, and if interest rates, even if they don't go up dramatically, are still on the northward trajectory in the West at least, arguably even in India. What's your sense about what does that do to equity risk premia vis-a-vis other options available for 2023?
Right. Well, from a short-term perspective, it's always difficult to get a sense of these things. But yes, it is a structural change in many ways. I think Howard Marks put out his memo a couple of days ago, highlighting the same thing. I think his title of the memo was very well put as a sea change. It's a sea change, right? It's a dramatic change from the last 40 years, particularly the last 13 years, as he makes it out to be, since 2009, as far as the monetary situation globally is concerned. And I don't think he's far off the mark in terms of suggesting that we may not revert back to those times ever again. Ever again, at least in the foreseeable future. So that has bigger ramifications from investors' perspective, from the real economy perspective going forward. So one aspect of looking at it is, like you mentioned, equity risk premia, which is effectively what choices do investors have. Over the last couple of decades, given the low interest rate scenario, obviously people had to forcibly look at risk assets to generate the sort of return on their savings to be able to fulfill their financial aspirations, whether it's retirement goals or any such thing. Now, with, say, the US 10-year Treasury giving you 4%, that desperation to go after risk assets is that much less. So your asset allocation will structurally change, unless and until, of course, there is still a small school of thought who reckons that this is just a blip. Sooner or later, we'll go back to the good old days of low interest rates, because the world has just been addicted to this, and there's no other way we can live. But I think the consensus is soon building up that we may not see those things. In that case, I think it'll be a far more sensible or rational way to invest globally, both from an asset allocation perspective and within each individual assets, choice of securities will also be far more rational than the sort of crazy mania that we saw, where literally everything went up, right? So it'll be a market for the more discerning investor, where you can separate the wheat from the chaff. It's not going to be that easy making money. But specific to your question, implications on equities, clearly not the greatest. I think the best period for equities from a global perspective, at least at the index level, is behind us. You will need to work that much harder to pick great companies to be able to achieve the same sort of returns that we achieved over the last 10, 20 years. So it'll be more of a bottom-up market, which, I don't think we'll worry too much about it.
Yeah, that's true. The other pieces, and a lot of people have made this point in the last 2 months, Pramod, and which is why I ask you, because, forgive me for making an assumption, but if my assumption is true, then great. If not, then please correct me. But a lot of people have made this point about how the days of buy and hold for a considerably long period of time are now behind us, because the world is that much more volatile. Now, I presume that you at Marcellus have an affinity for the buy and hold strategy, because good companies should be held for longer, etc., etc. My question is, and it may not have worked in some periods, it definitely, you can't outperform every single year. So that point is a given. My question is, do you question, if your strategy has been largely buy and hold for long term, do you question that in the current world thesis, or do you believe that, over a long term, things will even out? And there are a lot of assumptions in my question, so please excuse me for that.
No, you're absolutely right. I think it depends on what horizons you look at, right? If you look at shorter term horizons, everything will look volatile, right? So even the best stocks, even the lowest volatility stocks you can think of, will look extremely volatile from a chart perspective. As you step back and you expand your horizons, you will see that even the most volatile stocks look like a straight line. If you go back into decadal views, that's always been the case. I don't think that is changing. Yes, volatility has gone up for other factors, such as, say, the advent of algorithmic trading, the amount of machines involved in trading today, which are dictated by rules which are far more discrete than continuous. And also at the same time, the advent of passive investing, which is in some ways against your classical definition of value investing. Remember, passive investing is all about investing in indices which are formed based on free float market cap adjusted, which means that if the market cap goes up, the weight in the index goes up and you buy more of that, which is the antithesis of value investing. You typically buy something that comes down and sell something that goes up. But passive investing has created this complete anomaly, which creates its own inefficiencies in the market structure and hence contributes to this volatility. But if you leave that aside, even if you take the last 40, 50-year view, where stocks have done well over these long periods of time, you will see specific periods in the interim where they have been extremely volatile. So those challenges are not going away. Going forward as well, you'll have to live with volatility. In fact, if the volatility is even more, all the more reason to look at a buy and hold strategy, as long as you believe that the hypothesis with which you bought or you got into the stock remains intact. Because it's going to be difficult, if not impossible, to time yourself into this volatility. I mean, it is tempting. It has always been tempting for the human mind to see that, what if I get out of this and get back in when the bottom forms? But in my experience, at least, we have struggled to do that.
Okay.
Hence, we've reverted to a more buy and hold approach. Honestly, I haven't seen too many people successfully doing that either. So that means that it's not just us. Most people would struggle to do that. And hence better to take a longer term horizon, because in the longer term, equity as an asset class is upward trending. And specifically stocks with strong fundamentals, you will by and large end up with a reasonably positive outcome, as opposed to trying to be too cute and get that extra bit of return
Sure.
by getting out and getting in at the right time. Unfortunately, in reality, you will end up doing exactly the opposite thing.
So the deck seems to be set for example, a Kings of Capital portfolio that you guys may have, or financials at large to do well, Pramod, because there seems to be almost a near consensus that banks or BFSI would do well. Where I would want, and we've discussed this in the past with you, where I would want to kind of pick your brains a little bit is that how do different facets within that pocket do relative to each other? So would large banks do much better than small banks from a return perspective, considering that the fact that they are also slightly more richly valued than what the small banks might be? Part one of my question. Part two, a lot of people are talking about how banks per se will do well, but NBFCs may not, but select NBFCs might be doing okay. Now, I know in your portfolios, and this I'm only talking about the lending financials. We'll come to the non-lending ones in a bit. How do you think about this large banks, small banks, NBFC mix within your portfolios for the next 1-2 years?
Right. So look, I think we're perhaps one of the first ones to highlight the attractiveness of financials as a sector. We launched our financials strategy almost 2.5 years ago. Unfortunately, the returns of the strategy hasn't played out as much as the rest of the lenders, but we are okay because our investment philosophy has a certain definition, and sort of stocks that we play, or rather we pick for our portfolio, are in line with that definition. Having said that, I don't think it's going to be as easy going forward, right? So the early pickings in terms of loan book growth, the fact that we've had cleansing of the balance sheet across the sector for the last 5-6 years, that's pretty much in the price. And like you said, it's becoming a consensus trade now. Valuations, even for some of the banks which had performed really badly over the last decade in terms of asset quality, are no longer that cheap. They've all come back, especially some of the private sector banks which had a troubled last decade. They're trading in line with an HDFC Bank or a Kotak Bank now. So that suggests that it's becoming a consensus trade, that there's no more easy pickings here. And separately, I think you're also seeing pressure on the deposit side coming through. So the early wins in terms of interest rates high coming through, your loan book getting repriced faster than your deposit book, resulting in margin expansion, that's also played out. Now, in fact, you'll have to pay through your nose in terms of garnering deposits to fill up the loan demand that you're seeing. To that extent, you will have to separate the men from the boys here. Those who will succeed will necessarily have a stronger liability franchise. Remember, it's always easy to lend money. There'll be plenty of people willing to borrow money. First is, are you lending money at rates which appropriately price the risk of lending to that borrower? And if you're pricing it appropriately, do you have the funding costs which will still allow you to make those margins at those rates, which is what will determine the returns across the cycle. This is the easiest period of the cycle for banks. You're in the business of giving money. There'll be plenty of people waiting to take money. When it comes to collecting money, all these things matter. Did you price that risk adequately? And having priced that risk adequately, have you left enough margin and ROE for yourself? That's why it's the fag end of the credit cycle. You'll see the good and the bad get separated. So we're perhaps a year or two away from that, when the next 2 years is all going to be plenty of lending growth to show. But at some stage, the cycle will turn south, and that's when we'll see, the prudence of lending for many of these lenders.
So you sound circumspect. Are you circumspect? Or are you still constructive?
No, not as I would say selectively constructive. Like I said, 2.5 years ago, we said financials is going to be the sector to go after, and financials have done well, extremely well. I don't think it's going to be that easy going forward. People need to be a little more watchful in terms of the sort of lenders they play. Focus on liability strengths. Once you have the liability strengths, you can afford to cherry pick the borrowers. You can cherry pick safer borrowers, because for you to achieve the same margins, you don't need to go after increasing your lending rates. At the same time, a history, a track record, a culture in terms of prudent lending is also important, because it is inevitable that the cycle will turn south. It is inevitable that we'll see another bout of NPAs come through the fag end of the cycle. At that time, you shouldn't be caught with the sort of lenders who will bear the brunt.
Got it. Since you look back at history so long, I would suspect, Pramod, that you've been not tempted into buying into PSU banks.
Yes, we've stayed away because we've created, like I said, we created a certain investment philosophy. We're not the sort of investors who say that, look, it's all about making money. It doesn't matter how you make it, right? At some stage, perhaps in our younger days, we thought the same, but only to learn our lessons the hard way. We realized that you need a process, you need a philosophy. You say that this is what we will try and achieve. This is what we're good at. It plays to our strengths, and we stick to that. So we've at the outset, we've said that we will look at businesses which can make a return on capital greater than cost of capital, because we believe that if that doesn't happen, there's no economic value created.
Sure.
and you can make a sense that, okay, historically they haven't done it, but in future they'll do it. You can do that, but it becomes borderline speculative there. Right? So we want to see evidence of that business showing that they can create economic value, which is simply boils down to generating a return on equity or return on capital greater than cost of capital. The PSU bank space, we haven't seen any evidence of that, right? Even after this recovery, the best PSU bank, which is State Bank of India, is barely touching cost of equity. And this is the best part of the cycle. Like I said, you've cleaned your books, your past NPAs have been written down, or you got lucky with the recovery around steel NPAs coming through. Let's see one cycle. If you can lend and still achieve an ROE greater than cost of equity on a cross-cycle basis, when the NPAs come through, when the credit cycle turns, we're more than happy to change our minds. But we've set our process in such a way that you'll have to have had a reasonable amount of history where you've delivered that excess return over cost of capital to make it into the portfolio.
Got it. In which case, if banks aren't the space to go after as strongly, what is the space to go after as strongly?
I mean, for us, it's always been bottom up. The banks was a obvious story that was playing out, but we've constructed the portfolio in such a way that we can straddle the lenders and the non-lenders based on the point in time of the cycle. So now, while I think that the easy money is over, I think for banks like HDFC Bank and Kotak Bank, they're barely done well from a 2-3 year perspective, right? Both on an absolute basis, even worse on a relative basis. Now, if you say the most recent quarter, both in terms of loan book growth and earnings growth, they've demonstrated spectacular fundamentals. So at some stage, these banks will have to catch up on that rally. I'm not saying they will suddenly start re-rating, but if you're growing earnings at 20-25%, you're likely, and remember, they're no longer as expensive, both on an absolute and relative basis. Even if you get returns in line with your underlying earnings growth, I think there's plenty of money to be made. Most of us will be happy with that 20-25% sort of a return. So there are pockets in the banking sector. There are pockets within the NBFC sector as well. Remember, NBFC sector has also been punished because NBFs generally tend to suffer in a rising rate environment because they don't have the advantage of CASA, much like banks. But not all NBFCs are created equal, right? Some NBFCs have better liability franchises.
Sure.
Ones that we own are Bajaj Finance, both a great liability franchise as well as a very high enough capital adequacy ratio.
Sure.
Affordable housing finance twins that we own, Home First Finance and ours, both have very high capital adequacy ratios, which allows them to still go to the money market and borrow at fairly competitive rates, and hence you become sort of immune to the interest rate cycle. What happens is some of the weaker peers who don't have that stronger liability franchise, they tend to bear the brunt of higher cost of funding. And that makes them less competitive, and that allows these sort of NBFCs to gain market share even during these times. So therefore, there is an opportunity to play within banks and NBFCs. Like I said, you need to be discerning enough. The easy pickings are over. And at some stage, the insurance plays will also come in. Remember, both HDFC Life and ICICI Lombard are picks on the life and insurance sector, which we own, haven't particularly done well over the last 2-3 years. So there is a catch-up trade. Both have been continuing to gain market share even during this period. Yes, life insurance industry as a whole is seeing some slowdown in terms of top-line growth. But if you take the long-term story, significantly underpenetrated when it comes to term insurance in India. Likewise, on the general insurance side, both health insurance as well as motor insurance, and both are fantastic franchises. So it is a bit of an anomaly that we feel that the banks and financials in general have had a great run. Unfortunately, our portfolio companies are waiting to catch up.
Okay. In which case, my final question. So you answered that what within financials, but like I was trying to ask, that if financials selective, you might be the go-to space, but like the way you came out 2.5 years ago with your financials portfolio and spoke about that pocket being the pocket to go after, is there a pocket to go after? As much as your bottom up, are there one or two themes that emerge strongly from a cluster of companies which might be present across portfolios, and therefore the theme by itself looks strong?
Well, I think we've talked about it in the past as well. From a thematic perspective, the pharma and chemical space sort of stands out, particularly in the API space, where we're seeing both a sort of top-down theme playing out through the China plus one factor, as well as bottom-up. Plenty of companies have built very strong track records on the chemistry front to be able to come up with sort of new products to high R&D capabilities. So that theme continues to play out, and we have enough exposure on that as well. The other is around, I think, finally, industrials, where we might see some comeback. For a long time, industrials have had a hiatus. We've had a bit of a run as far as stock prices are concerned, but from an earnings growth perspective, we haven't really seen that play out. If we believe that this economic cycle is here to stay in terms of running up, we might see some of the industrial plays give at least a longer term return. I mean, I can see that people see that it's already rallied well enough, but
I was about to say, your ex-house Ambit recently put out a note wherein they put a blanket sell on a bunch of these guys, citing expensive valuations, while admitting that the earnings growth might be strong.
But it's similar to what I talked about financials, right? The easy pickings might be over, where you could buy any of these industrials. Now is the time to look more carefully and to bottom up. But from a thematic perspective, for as far as earnings growth is concerned, I think we are at the right stage of the cycle. But stock picking will have to be bottom up.
Got it. Pramod, great having you as always. Thanks so much for taking the time out, and wishing you and Team Marcellus a fabulous holiday season.
No, thank you so much. It's a pleasure to be here again. And just as a disclaimer, the stocks that I mentioned, most of it we own in our portfolios, including my own portfolio as well as our clients' portfolios.
Sounds good. Pramod, lovely having you, and viewers, thanks for tuning into this edition of The Talking Point.